जी हैं ਤੁਸੀਂ ਦੇਖ ਰਹੇ ਅੱਜ ਕੱਲ ਅਮਰੀਕਾ ਸਾਂਝੀ ਸੋਚ ਟੀਵੀ ਤੇ ਮੈਂ ਇੰਦਰਜੀਤ ਕਾਲੀਰਾਏ ਆਪਣੀ ਗੱਲ ਹੁੰਦੀ ਹੈ ਜੋ ਅਮਰੀਕਾ ਦੇ ਵਿੱਚ ਅੱਜ ਕੱਲ ਚੱਲਦਾ ਹੈਗਾ ਥੋੜੇ ਕੁ ਦਿਨ ਹੋਏ ਆਪਾਂ ਗੱਲ ਕੀਤੀ ਸੀਗੀ ਜਿਹੜੀ ਆਉਣ ਵਾਲਾ ਸਮਾਂ ਹੈਗਾ ਉਹ ਟੈਕਸ ਸੀਜ਼ਨ ਹੈਗਾ ਜਨਵਰੀ 20 ਤੋਂ ਫੈਡਰਲ ਸਰਕਾਰ ਨੇ ਸਟੇਟ ਸਰਕਾਰ ਨੇ ਆਪਣੇ ਟੈਕਸ ਫਾਈਲਿੰਗ ਓਪਨ ਕਰ ਦੇਣੀ ਹੈ ਜਿਹੜੀ ਆਨਲਾਈਨ ਫਾਈਲਿੰਗ ਹੋ ਸਕਦੀ ਹੈ ਇਹ ਔਰ ਸਿਸਟਮਸ ਉਹਨਾਂ ਦੇ ਜਾਣੀ ਚਾਲੂ ਹੋ ਜਾਣੇ ਆ ਉਹਦੇ ਵਾਸਤੇ ਚਾਹੇ ਆਪਾਂ ਇੰਡੀਵਿਜੂਅਲ ਆ ਚਾਹੇ ਆਪਾਂ ਬਿਜ਼ਨਸ ਹੈ ਆਪਾਂ ਨੂੰ ਤਿਆਰੀਆਂ ਕਰਨੀਆਂ ਪੈਣੀਆਂ ਤੇ ਟੈਕਸਸ ਫਾਈਲ ਕਰਨੇ ਪੈਣੇ ਆ ਜਿੰਨੇ ਵੀ EMPLOYEES ਹੈਗੇ ਆ ਉਹਨਾਂ ਕੰਪਨੀਆਂ ਨੂੰ W2 ਭੇਜਣੇ ਪੈਣੇ ਆ ਉਹਨਾਂ ਦੀ ਤਰੀਕ ਹੁੰਦੀ ਹੈ ਯੂਜਲੀ ਜਨਵਰੀ 31st ਤੇ ਆਪਾਂ ਜਿਹੜੇ ਟੈਕਸ ਚੇਂਜਸ ਆਏ ਨੇ ਦ ਬਿਗ ਬਿਊਟੀਫੁਲ ਬਿੱਲ ਜੋ ਕਾਂਗਰਸ ਨੇ ਪਾਸ ਕੀਤਾ ਸੀ ਟਰੰਪ ਸਾਹਿਬ ਨੇ ਸਾਈਨ ਕਰ ਦਿੱਤਾ ਹੈਗਾ ਉਹਦੇ ਬਾਰੇ ਪਰਸਨਲ ਟੈਕਸਸ ਤੇ ਗੱਲ ਕੀਤੀ ਸੀ ਅੱਜ ਆਪਾਂ ਗੱਲ ਕਰਦੇ ਹਾਂ ਜਿਹੜੇ ਬਿਜ਼ਨਸ ਟੈਕਸੇਸ਼ਨ ਹੈਗੇ ਨੇ ਆਪਣੇ ਨਾਲ ਜੁੜੇ ਨੇ ਹਰਜਿੰਦਰ ਗਿੱਲ ਜੋ ਡਾਇਮੰਡ ਟੈਕਸ ਕੰਸਲਟੈਂਟਸ ਦੇ ਨਾਲ ਹੈਗੇ ਨੇ welcome to Aaj Kal America, Harjinder, and we're going to continue our conversation on business taxation. We did personal taxation a few days ago. Give us an introduction on Harjinder Gill and Diamond Tax Consultants.
So my name is Harjinder Tiger Gill. A little bit of background about myself. I first started working at the California State Board of Equalization for about 10 years. Then later on, I transitioned to Aerojet Rocketdyne. And then further, I worked at Internal Revenue Service as well. And I also worked at Type Chart Construction. And then recently, last few years, I opened my own firm, Diamond Tax and Financial. And I served the greater Sacramento area as well as California and all over the United States as well. And one
Thank
more
you on
thing
that.
is also my education. My education
Carry
as
on.
well, background stuff. I have my bachelor's in bachelor's in accounting from Sacramento State University. I also further my studies by obtaining my master's in accountancy and taxation from Golden Gate University, and also a master's in accounting with data analytics and AI from Golden Gate University as well. So
Great. Like I just said earlier in the introduction, we did personal taxation changes that are coming up in the big, beautiful bill passed by Congress. Even though they passed it, we talked about some limits that have been put in there or expiration dates on some of the features they provided. What we hear now, they're still trying to discuss the future of Obamacare, but they haven't got any answers on that yet. How are we going to expect this big, beautiful bill to impact businesses? Just a brief overview before we get into the nitty gritty.
So with the big beautiful bill, it's pretty much catered to a lot of startups, solo entrepreneurs, business that want to expand their operations. So, for example, the new big beautiful bill it permanently locks in lower income tax rates for taxpayers and the the lower income tax rates in brackets created by the 2017 Job Cuts and Tax Cuts and Jobs Act. And without the big beautiful bill, tax rates will automatically increase for everyone. So the new big beautiful bill adds an extra inflation adjustments to the tax brackets of 10%, 12%, and 22%, which helps prevent, like, if your income increases and you get annual raises, you won't jump into a higher tax bracket. So, for example, if you're a business owner and you earn over 100,000 a year, under the old law, your small raises or small increase in income could slowly push your money into a higher tax bracket. Without these permanent brackets and inflation adjustments, you keep more of the same rate each year without going into a higher bracket. You don't go from 12% to 22%.
Got it. So basically, a feature that was not there before, if I heard you correctly, they're going to allow for inflation which is going to automatically adjust these limits in the coming years?
Yes, from year to year, from 2025 and after.
Okay, so whatever the CPI is as reported by the federal government, then you will automatically get those changes in your tax limits, whether there's any changes to law regarding individual or business. Is that both individual and business taxes or just business?
Correct, both individual and business.
Okay, cool. Um, Help me out a bit. What's QBI?
Is Consumer Price Index.
Okay, and the QBI.
Mhm. Sorry, QBI. Sorry, CPI is Consumer Price Index, and QBI is Qualified Business Income Deduction. So,
Okay,
so with this
Qua-
Q,
sorry,
but
qualified business income.
income deduction,
Okay,
yes.
so what is the 20% QBI deduction then on that?
So the QBI business deduction, it is, so let's say suppose you make 100,000 a year, and so you get 20% off of a business deduction off your income. So instead of being taxed at 100% of your, say you made 100,000, instead of being taxed at 100,000, you'd be taxed at 80,000 of
Okay,
taxable
is
income.
that comparable to the personal deduction that we get on the personal taxes?
No, that's totally separate, depending on the
Okay,
business entity. So if you're
got it,
like a Schedule C or solopreneur, entrepreneur, you get your whatever income, you get a 20% deduction off of that. If you're LLC or if you're a corporation or so forth, you get 20% off your qualified business income deduction off of that.
got it. And so, what do we have as part of Section 179 in collaboration? And then there's a bonus deduction, depreciation deduction.
Yes, so with this new laws, we have the new, um, we have business vehicle deductions. Um, it's where business can deduct in loan interest, insurance, maintenance, operating costs, proportion of business use. So the difference between section 179 and bonus depreciation, with section 179, business can expense up to 2.5 million of assets in 2025 with caps for SUVs over 6,000 pounds um, at 31,300. With the bonus depreciation, you can restore up to, you can get the 100% bonus depreciation with no caps. This idea for trucks, vans, fleets, and so forth.
Okay, so if you have a business and you have a vehicle, uh, your business vehicle or your truck or anything that you're doing in that business, you can do 100% deduction on that in the first year.
Yes, sir.
Okay. Now, I understand when we have like a 5 year depreciation plan or a 10 year depreciation plan, does this immediate 100% impact our future business income? Because if I'm going to take all my automobile expenses this year because the big beautiful bill allows me, what happens next year?
So if you do decide to use your, like, say you buy the $50,000 vehicle, 100% business use, you can deduct the $50,000 in 1 year. Or you can elect to do, um, if you elect all in 1 year, then that 50,000 is gone. And then for next year, if you have income, you have no deductions. So every taxpayer should consult with their tax professional, CPA, EA, or accountant, and say, okay, if I make all these deductions the first year, like say if I expense my vehicle 50,000, use the bonus depreciation, in forecasting your next couple of years, you have to consider doing more tax planning. So you can do, instead of doing a bonus depreciation, you can also do the double declining depreciation, where you can depreciate over 2.5 years, or you can do straight line depreciation, where you can expense it over 5 years.
So you have a choice of one of those, but if you take the 50,000 deduction in the coming tax filing season for 2025, you won't maintain that deduction for future years. So if your income goes up, you won't have a deduction against it. Therefore, you're likely to pay more taxes because you don't have any deductions. And I'm just curious which way is better, taking it all this year or taking it over a period of time. On average, uh, with your experience, which one is usually better?
It also depends on your how your business performs. If your business is performing and elitely and you're making, let's say, like over 150,000 a year or so, give or take 180,000, then you better expensing the first year, and next year buy another business asset or a vehicle, whatnot, buying that or trading in one of your older vehicles, older fleet, and buying a newer vehicle for business use.
Now, correct me if I am misunderstood it. Is this only available for vehicles, or is there any other assets I could acquire that this applies
So
to?
with the So the big beautiful bill is good for this is like expensing mostly vehicles, but you can also appreciate it. So the new big beautiful bill we have, we can deduct it based also off of like equipment you buy. So with the new big beautiful bill, we also give incentives to new US manufacturing companies and factories. So any business equipment you buy and is 100% business use, you can expense 100% of it of qualified production property in the first year instead of trying to depreciate over 39 years.
Got it. And if I'm buying this car, I'm deducting the 50,000, but I bought it on finance. Does the 50,000 still apply?
Yes, it still applies. As long as the
Okay.
vehicle is financed or purchased outright, but not leased.
Okay. So then the if I finance it, I can take the 50,000 off the books as an expense in my first year, and but I'm
Mhm.
still paying interest on the loan. So am I allowed to deduct the interest on that loan?
Yes, you can.
Okay. So even though I take the depreciation in the first year, the loan that I have on my vehicle, I can still carry on deducting the interest in future years.
Yes.
Is there a cap on that?
There's no cap on that.
Okay, so I could buy 100,000 vehicle or a Lamborghini at 500,000. It's all the same.
Yes.
Okay. Um, is there a limited limitation on the adjusted gross income?
There's no limitation on adjusted gross income. Um, but for this, like for section 179, there's a limit that where the assets can be over 2.5 million, and for bonus depreciation there's no cap. So right now your bonus depreciation is more of the realistic option for a lot of business owners. Because before, under the old law, under the Tax Cuts and Jobs Act from 2017, bonus depreciation was only was its goals in 2025 was going to be at 40%. As of January 19, 2025, the big beautiful bill, you can expense 100% of the depreciation the first year.
Okay. And
So whereas you got a $50,000 vehicle under the old law, you can only dispense expense for 20,000, where now you can expense up 50,000 with the
okay,
bonus
got it.
depreciation.
What about any other business purchases that I have and I finance these purchases? Do I have interest deduction on those?
Yes, you do. Um, Also, another one that's really important right now is the big beautiful bill. It permanently restores the 100% expensing of R&D costs. So let's say you're starting a new business, whether you're in the field of technology, manufacturer, engineer, innovation, are are starting off, like say a nursery, for example, any cost you have of testing, research or development, they're all expensed the first year.
Okay. Okay. Um, there's sometimes a business doesn't make a profit. So how do we define net operating loss, and what is a carryback on that? So if I made my business made a loss last year, can I carry that over this year as a deduction?
Yes, you can, but however, with the new NOL laws, I think after 20, I believe it's 2020. Don't quote me on it, but you can only carry a limit of how much you can carry per year. Usually it was 80%. Under the new law, I don't. They haven't really made adjustments to that, but hopefully they can restore it to 100%. But right now, it's only at 80% of operating loss. So if you like lost 100, you have a net operating loss of 100,000 from the prior year, and in 2025 you made, let's say, 100,000, so you only got 80%, so you can use 80% of the loss from last year and to write off for 2025. So if you made 100 grand, you can deduct 80,000 from the prior year of loss, so your income is 20,000.
Okay, so um, I had a business where I bought 2 or 3 vehicles, and the money I spent on those, I'm actually financing, but
Mm-hmm.
because I can write them off as a business expense, I could actually
Mm-hmm.
physically end up with a loss this year, which
Mm-hmm.
may not be maybe more than what I can write off this year. So whatever excess I have left over, I can carry it to next year. Did I understand you
Correct.
right?
Yes, sir.
And how many years can I roll this over?
You can roll it all years until it's fully used up, so you can move forward them indefinitely.
Okay, so if I roll my 3 vehicles, they're 150,000. I got 100,000 left over of losses from this year. I can roll the 100 over to the following year, or do I get
Mm-hmm.
to roll over a percentage of that?
You 100% it. So right now, with the current loss, you can only roll 80% of it. So
Okay, so
80% from
I've
the
got a
prior year.
hundred. I got 100 in excess losses. I carry that over to the
Mm-hmm.
following year, but I can only take
Mm-hmm.
80% of that. So now I've got
Correct.
20,000 left over to take over to the following year. Now, is that still
Correct.
limited to 80% of that 20?
Yes. So it's whatever. So if you like say the following year, 2026, you say you have another $100,000 gain, you can only write 80% off that. So the max you can use of that will be of 16,000. So you keep using it over and over. So you can only use 80% from the following year as a loss. I'm sorry, whichever year. So sorry. So if you have, like, say you made another 100 grand in 2026 and you got a
Mm-hmm.
$20,000 net operating loss carryover, you can use the 20,000 long as it does not exceed 80,000.
Okay. Okay. All right. Um, how do I? Is there any changes to what I do on my meals and entertainment when I'm out on business meetings? And what are the parameters of meals and entertainment?
So meals and entertainment, along as they're reasonable and legitimate expenses, they're allowable under the IRS rules and regulations. The meals per diem in 2025, I believe, is still around $69 per day per diem. So that includes your lunch, breakfast, lunch, dinner, incidentals for the whole day.
Okay, so basically, I think you said $59 something for the whole day. So it's about 20,
Yeah. So
about $20 a
yeah,
meal for 3 meals a
yeah.
day.
So yeah, so what they did is they changed. It depends on the level. So right now they changed it to depends on what kind of industry you're in. So if you're in the continental U.S., you're allowed $74 per meal per diem, meals, entertainment expense. However, if you're in a high cost locality, you can do $86 per day. If you're in the industry, transportation industry, it's up to $80. If you're um and long as you don't need receipts, so without the per diem, you don't need receipts, but per diem you're allowed depending on the industry and locality. So if you're mostly if you're in trucking industry, you're allowed up to $80 per day in the continental US. Outside the US, you're allowed $86 per day.
Okay, so this $80 number or the $59 number is without receipts. So if you, let's
Right.
say, you got your business and I'm going to be a prospective client, you take me out for dinner. If you have a receipt, you can deduct that full amount because now there's a receipt.
Mhm.
Is there any limits on what can be on that receipt? And we decide to have a beer each. Is that allowed? Or is alcohol or beer
So
restricted?
you can have it, but long as it's part of your breakfast, lunch, or dinner. But and you can also include their tips on food and service, and some are also included are like incidental like baggage tips and so forth. There's certain things you can allow, but long as they're legitimate and for business purpose use only, is allowed under law. So having
Okay.
one beer is not really going to hurt.
Yeah. But I believe when we were working, I was working for the state. I recall per diems being not for consumption of beer or something like that. Anyway, we have employees in our business. How can we deduct employee retirement plans, health plans, and are there any changes to that?
So with the new laws we also have where it is like if you have employees, so they can also get a paid family medical leave. So we also have that where if your employer paid for your paid family medical leave credit, you also get that as well. It allows credits based on premiums paid by employers. It also employs minimum employee work requirements to 6 months, and it's included nationwide in all 50 states. So that's one thing to change for the big beautiful, and this also helps support working families by incentivizing employers to offer paid leave.
Okay, so, but if I'm offering paid leave to or my employees, I'm only going to benefit from the tax deduction, not the fact that I actually paid them for work they never did.
Understand, but it just at again, it's just it's the way to kind of keep employee retention and also keep employers from still employing keeping employees at same without having high employee turnover rate.
So basically, it's building the continuity of trained employees and giving them the
Mhm.
benefit or the privilege of having time off for family needs and stuff like that. Which, I, on the other side of it, we might have allowed that anyway, but now legally we can allow that and we can deduct it as a benefit that we gave to our employees.
Correct.
On the healthcare, are there any options for like group plans for small businesses?
Um, it all depends on your level of work health plan, a program your employers decide to be on. So, for example, you have this one healthcare plan where it has so it has what enables medical. So yeah, for the new HSS system, it also allows for health plan for employers to deduct medical premiums and costs paid for the employees, including including uh, premiums paid, including uh, pay incentive of sick leave, paid leave. It also gives them a deduction for if you have more than 5 employees, depending on the plan and program, they can offer to have a deduction on their tax return.
Okay. Um, what about my, as a business owner, what deduction can I have on my own health premiums?
You as a business owner, you can have self-employed insurance premiums that are fully deductible, and any out-of-pocket costs are also deductible to the employer as well.
Okay. Um, moving on from the benefits to or the deductions, what's the difference between an S corp and a C corp?
So the S corp, difference between an S corp and a C corp is S corp is a shareholder base, and then the C corp is closely held. So pretty much any net operating loss you have in a C corp, you can't distribute those. They're stay inside the corporation. And with the S corp, let's say if you do S corp election, any like losses or whatever you lose, like say you had a $30,000 loss, you can take that income and put it onto your personal income tax return as a take it as a deduction as a loss. So let's say you made in a C corp, you have $100,000 loss, right? The $100,000 loss, you can't put that towards your personal income tax return because this closely held any losses or gains in a corporation, a C corp, stay in the corporation. And your dividends, C corps are always dividend, S corps are distributions. With the S corp, let's say suppose you have a $30,000 loss, you can take that S as a negative $30,000 ordinary income on the K1, put it towards your personal income tax return. Let's say you had $50,000 in W-2 income, just gross income, let's say, the 30,000 will offset 50,000, the 30, negative 30,000 offset the 50,000 income you already have. So you'll have um, a positive 20,000 of adjusted gross income.
So if I'm going to go into business, and let's go back a year. So it's January 1st, and I want to set up my new business. What should I do? Go S corp or C corp?
It all depends on the taxpayer goals. Some taxpayers will disallow, like depending on what industry they're in. If they're in hotels, a lot of hotel owners prefer C corp. However, if you're in the trucking industry, which I recommend, a lot of them are S corps. So I always recommend S corp because you can always pay yourself a W-2. You can always pay yourself a salary, and any ordinary income left over, you can put that towards your personal income tax return. It gives you much more incentive. Like say further later on down the future, you want to get a loan, you want to be show more profitable, or you want to have more options. So S corp is the way to go, and you get way more deductions in S corp than you do a C corp.
Got it. Since you added the topic of want to get a loan, um, you're a small business, just started up a couple of years ago, and you're an S corp, and mostly I've concentrated on showing losses by taking as many deductions as I can. When it comes to a desire or a wish to buy a house because the Fed was going to lower the rates this couple of weeks ago, and I'm encouraged to step into the housing market. How does taking as many deductions as I can to show the least amount of income in my previous years impact me getting a mortgage loan now?
So it all depends on your mortgage lender and the amount of the loan you're trying to obtain. So working with your mortgage lender, they can always tell you that you need X amount of income per year for the last 3 years. So if it comes down to if you reported least amount of income for the last 3 years, you only showed you made 30,000 when you made 300,000. So what you have to go do is go back and make your S corp and your C corp returns and go back and make adjustments. If you try to decrease the income more than what you made, say you made 50 grand, and you say, oh, if you made 20 grand, then you're more likely to get audited. But if you increase your income from 30 grand to 100 grand per year, then is it takes, so once you amend the returns, it takes about 8 to 12 weeks for the IRS to process them. And then your tax professional, tax representative will have to fill out a form and verify your income, and then you will be able to obtain a loan.
So we've just covered the deductions that were allowed on our business taxes for employee meal deductions and the business owners' meal deductions and per diems and their limitations.
Mhm.
Moving to other deductions that we can get is healthcare. If we have a healthcare plan that our employees are buying into it and we're subscribing, contributing to the healthcare plan, that's deductible. And what about the business owner's healthcare plan?
Yes, that's also deductible as well. Um, with the plan, along if they show sufficient supporting documentation that has been paid for, they can expense that as well.
Okay, is there a limit on that?
There's no limit.
Okay, so if I sign up with Kaiser or I sign up with any other health plan that's available, the premiums that I pay as a business owner for myself and my employees, they are deductible as a business expense.
Correct.
Did the big beautiful bill change any of that? Because I think it's been
Yeah.
allowed for previous years.
They also have a change with the paid family and medical leave. So with the paid family and medical leave credits, the credit is permanently extended and expanded. So if you're a small business owner and you're offering paid maternity leave or medical leave, as an employer, you can now claim credits, tax credits more easily, helping offset payroll costs and also while supporting employee retention and appreciation at the same time.
Okay, so if I have an employee who needs to have maternity leave, or if an employee has a family member they need to take care of, I can give them the time off and give them paid family medical leave for that, and then also be able to take that as a deduction on my business expenses.
Payroll. Yes.
Payroll. Okay. What about retirement plans?
Same with the retirement plans. So with the new retirement plans, there's a deduction for self-employed as well.
Okay, so could this be like an IRA or something?
So with the new plans they have, so they have the like say you let's say for example you have the Roth IRA. So it's probably one of the best plans out there for self-employed entrepreneurs, startups. It has tax-free growth and tax-free withdrawals in retirement. That's one. There's no changes to that. It's not affected by the big beautiful bill. Another one is the 401k. Is also you can elect to be employer for profit sharing, also employee for salary deferral, and it depends. You can be on a traditional RFA or a Roth IRA. It has employer contributes pre-tax, and it's much more higher. It has offers a much higher total contribution than the SEP IRA. It has no reduction in limits. It has no forced Roth IRA conversions and no penalty on high savers. So just one of the three things for that. And then another one, it is the SEP IRA. There's no changes with the big beautiful bill. So everything pretty much stays the same. And that's only good, mostly good for sole proprietors, consultants, single business owners, and someone employers that actually want simplicity over flexibility. So they're easy. They're employer only contributions, and their contributions based on business growth.
Okay. What we're hearing a lot of these days is the Obama health care plan, the Obamacare, or the Affordable Care Act. Every time we come to sort of budgetary crises or negotiations in the federal government, there's always a need to extend what they're calling subsidies. How is that current situation impacting employers and employees who are subscribers to the Affordable Care Act?
So with the new bill, it also hasn't. So we have more things. So with the new big beautiful bill, eh, the changes they had quite a bit of changes. So I can just let's go over like a few. For
Hmm.
example, with Social Security, yeah, retirees have to earn more income without reducing your benefits. So now the full retirement age is raised to age 68 for those that are born after 1975. So
Okay.
that's one thing. And they also have a lot of Medicaid work requirements for adults aged 19 to 55 that don't have independence. They must work at least 80 hours per month or participate in job training to obtain maintain medical care coverage. But they only exempt pregnant women, veterans, individuals with disabilities. Um, Also, they have a new thing called, as of, they're actually going to change to later on, is a new system where it limits Medicare care coverage for higher income individuals by introducing income-based premium surcharges. It phasing out some certain subsidiaries. So it also opens the door for more private alternatives, so increasing Medicare Advantage competition. So that's one thing they're trying to do with the Federal Care Act, and the big beautiful bill also weakens the Federal Affordable Care Act by eliminating individual mandates, penalties, allow states to opt out of essential health benefit requirements, and also allows the ACA subsidiaries to scale by changing their equity formulas, by scaling back and change their eligibility formulas. Um, this is pretty much like going to be a market-driven healthcare system, which could lead to higher premiums for older and sicker individuals. So if you're an older age individual, you're going to pay higher premiums than the average younger guy that's going to be in 19, 20 years old, or someone in their late 50s.
Right. So basically, when we're younger, we're healthier, the premiums will be lower. But as we age, we're more prone to age related illnesses or just more prone to getting sick more often. Then the market is going to factor those things in. Um, was the Affordable Care Act already doing that, or is it something that they brought in to change that now?
It's brought something to change that now. So, like, they also have coverage loss for income individuals. It puts a strain on Medicare and Social Security long term sustainability. It also creates a lot of legal challenges to Medicaid and Affordable Care Act related provisions. So this is just creating a whirlwind effect, like transitional, transformational shift from his real world effects that depend heavily on the state level rollout and judicial review. So it's quite a bit of challenges. And the big beautiful bill act, the reason for this, they feel like they can modernize Medicare for fiscal sustainability, but it also could become a slippery slope towards privatization. So pretty much it benefits more uh, private insurance companies offering these services.
Okay, I think the other side of the coin may be that in order to keep it, then the government on the other, federal government on one side, maybe state also, are having to provide subsidies which are coming from the taxpayer. So it's more of a balancing act. Have to go, either you go into the private sector and allow the market to make the adjustments, or you keep taking the money from the taxpayer and keep it artificially lower in terms of
Mhm.
premiums. But one way or it may still be a market driven system. It just depends on who's paying for it.
Yeah. And along with the system also becomes a lot of Medicaid changes for eligibility. So they're going to have income verification thresholds, annual recertification for all employees. The reason for this is to prevent fraud, ensure proper allocation of funds. They're also creating more stricter limits on federal healthcare benefits for non-citizen aliens. So it restricts Medicare for legal permanent residents with 5 years of lawful status. So pretty much, if you're a green card holder, they're restricting your federal healthcare benefits. Um, so they're more prior. So this provides a more shift towards prioritizing citizenship access. And it also creates a lot of healthcare equity concerns, depending on how states implement these rules. So California and New York and other states, I'm be really interested how they implement these new rules going forward. And they also created a new HSS system for preventing duplicate state Medicare enrollment. So they're trying to eliminate Medicare fraud. So starting in October 1st, 2029, Department of Health and Human Services must deploy a nationwide data matching system. So they will try to match someone's social security name, social security from to prevent duplicate benefits from a person in California. They can go to like a state of Nevada or New York and get the same benefits. So they're trying to prevent that. And then also they're also creating a death master file. So what a death master file is, beginning in January 1st, 2028, states must use the Social Security Administration death master file to regularly verify that medical recipients are alive and eligible. So it can't be just the family members getting benefits from a dead family member or relative.
Okay, so I think there was one case recently, a few weeks back, that a son, and this might have been in England, a son was dressing up as his mother and going to collect the benefits. But in fact, she had died a few years back, but he was still picking up her benefits. So at least something like that is going to be prevented, or there's going to be checks and balances for that. And I guess it's a benefit. Um, if I'm looking at going into a business and I'm exploring my options, what should I know about an S corp and a C corp, or what other types are there?
So there's plenty options. So you can go limited liability company (LLC). You can go that as a single owner. It has you protect, safeguard your assets. Um, if you just have like a business and you want to protect your asset, LLC is the way to go. If you have two members, And in the best way to go is a partnership, whether depending on if you're in a hotel industry or if you just have a side business and you're not really having day to day like operations hands on, then you're better off doing a partnership as a multi-member LLC as a partnership. A regular partnership is fine too. Um, but if you're trying to do, if you're producing about 15 to 20 grand a month, let's say if you're in the truck industry or any other type of industry, then you're better off going as an S corp. A C corp is also beneficial for some individuals, but they're closely held. So remember, in C corps, all the losses are stay in the corporation. You can never take that and distribute to your personal income. They always stay in the corporation, nonetheless. And any taxes you owe or anything, they stay in the corporation under C corp. S corp, you have more benefit, more options, and best of both worlds.
Got it. Okay. Double taxation, is there any benefits in either of those? Or how do you define double taxation?
So if you're in double taxation in your C corp, you get taxed on the dividend level, and you also get, you get taxed on the corporate level and also on the shareholder level. Um, but with the S corp, you prevent that by because you pay yourself a salary, and then that becomes a distribution, and the distribution is never taxable, only dividends. So C corp is always has dividend, and S corp always has distributions. And distribution are tax free.
Okay. So I could be subjected to taxes on the business side, and then I could also be taxed on my personal side for the same thing.
Correct.
Okay. All right. Pass through. What is a pass through?
So pass-through entity, the definition of pass-through entity is when any income that you receive is derived from your business to your personal. So it's like pass-through income. So pass-through income is business income that passes through directly as to a business owner's personal income tax return to your 1040, and it's instead of being taxed at the business level. So the owner does, and the pass-through doesn't pay tax on the federal. The business owner itself doesn't pay the federal income tax. The owner does. So if you're a sole proprietor, you're a pass-through entity. You're a Schedule C. You pay it on your personal income tax return. If you're a partnership or multi-member LLC, on Form 1065, you get a K1, which is a pass-through entity. If you're S corp, you file a 1120S form, you get a K1, which is also a pass-through entity. If you're single member LLC and you're a disregarded entity, you're also pass-through entity. Only one is that's not a pass-through entity is a C corp.
Okay. And under personal taxation, we talked about SALT, which was state and local taxes. How does that impact a business entity, whether it's S corp or C corp, an LLC, or however we define those things?
So if you're in a S corp, um, or like even like a LLC, and you have like say a business owner, let's say you have a properties, let's say for example rental properties, you can depending on deduct your, like say you're a rental property, for instance, you buy $1 million property, right? And you can deduct the business interest deduction, the property taxes, the interest or mortgage interest. You can deduct assessments. You can deduct any other like day-to-day operation expenses, maintenance costs. So it's not limited for that. And the SALT does not apply to business entities, it only applies to state. So it's only to personal 1040 returns.
Okay. Okay. Got it. We've been covering business taxation. Is there anything that is new that might impact business filing of taxes come 2026, other than what we've already covered?
Certainly. Yeah, so we have the new like as of September 30th, 2025, um EV credits, electric vehicle credits, tax credits expire after September 30th, 2025. So it's you get the tax credits are 7,700 for new electric vehicles and 4,000 for used electric vehicles. And after September 20th, 2025, there's no credits available after that. Um, Another one is like the new rules for gambling loss deductions. So whether you're in a let's say in a business, if you or if you're like individual, gambling losses are limited 90% of gambling winnings. Before it used to be 100%. So beginning in 2026, that's a new one. For mortgage interest insurance deductions, there's a cap of 750,000 interest cap that is made permanent. Um, so so they have mortgages originated before December 15, 2017. They remain grandfathered under the $1 million cap prior to this date, prior to December 15, 2017. Anything after that, after 2018, they have a $750,000 mortgage cap, and that's permanent. The mortgage insurance premiums, like say if you have a private medical insurance, PMI, FHA, VA, or USA DFEs, they're permanently deductible and they are subject to income limits. So you can like if it's explicitly stated that you have a PMI insurance, like say your FHA loan or VA loan, you can fully deduct those as expenses.
Okay. Earlier we talked about the inflation adjustments. When you mentioned that there's 750 permanent limit, is that likely to be inflation adjusted in the future?
Um, it can be. Can't really say, but it is that 750,000 cap is permanent going forward until Congress makes changes going forward.
Uh, and I think that key phrase, until Congress makes changes, applies to everything. So if we have a
Yeah.
change of administration, we may get changes. And also, we have expiring regulations, so we usually end up in an apparent emergency because something's going to expire and it has to be fixed right now. But we always burn the midnight oil on it. Well, what I want to do is thank you for this opportunity and the time that you've provided in helping people understand the business component of taxation filing come January 26. Um, I guess we'll get an update of taxes if there's any more things coming up for 26 later. And probably around April, we'll see how it's all going.
Yeah.
But before we go, how is it or why do some businesses file taxes mid-year or something like that? Because as individuals, we got to collect everything from January to December and file our personal taxation. But there's many businesses that don't file on the same schedule. What is the reason and why do some businesses have a different schedule?
So some businesses, like say, depending on what industry they're in, if they're in a farming season, they're a different type of farmer. They have fiscal years. Some have it from like February 1st to February. It's like February 1st to January 31st of each year. Some have it from April 1st to March 31st of each year. So it all depends what type of industry. If you're in the construction industry, they have their own fiscal year. If you're in let's say like a farming industry, they have their own fiscal year. So long it's been like when you open up your LLC or corporation, they make their adjustments to what when do you want to start your fiscal year, from what day to what day.
So is that like
And
the time I establish my business, then I start my tax from that year or that date, and then repeatedly for every year coming forward?
yes, sir. So you have to be consistent. So when you file, let's say if you open up your LLC in 2026, but like sorry 2025, and you decided, okay, I want to operate this LLC from March 1st to February 28th of each year. So when you file your taxes for in 2026 for 2025, you have to explicitly state your fiscal year from March 1st to February 28th of each year.
Got it. So as far as my individual taxes, I still go from January 1st to December 31st. But for my
Yes.
corporation or my business, is if I establish it, like you said, on March 1st, I go from March 1st to February 28th. Okay. So that's why there's a
Mm.
difference of filing requirements.
In S corps, they usually have a filing date of March 15th every year, and if they have extension, is September 15th. But all other returns usually from April 15th, with extension is October 15th. So, and
Okay. Got it.
also like to add one more thing. Congress also created another thing with the big beautiful bill. They repealed the $600 1099K reporting rule. So only time you're required is to report it is when you have over $20,000 in payments, a Venmo or 1099 PayPal, and over 200 transactions. So you have to have 220,000 in payments and 200 transactions to fully report it on your 1099K.
Okay. All right. Well, I think we should take a break now, and we've covered quite amount of depth on business taxations. So until there's more need of information, um, thank you for your time, and look forward to discussing more in the future. And
Thank you, Kevin.
ਚੈੱਕ ਬੈਕ ਵਿਦ ਯੂ ਲੇਟਰ ਥੈਂਕਸ ਓਕੇ ਜੇ ਤੁਸੀਂ
Thank
ਦੇਖ
you.
ਰਹੇ ਹੋ ਅੱਜ ਕੱਲ ਅਮਰੀਕਾ ਸਾਂਝੀ ਸੋਚ ਟੀਵੀ ਤੇ ਆਪਣੇ ਗੱਲ ਹੋ ਰਹੀ ਸੀ ਹਰਜਿੰਦਰ ਗਿੱਲ ਨਾਲ ਜੋ ਹੈਗੇ ਨੇ ਡਾਇਮੰਡ ਟੈਕਸ ਤੇ ਫਾਈਨੈਂਸ਼ੀਅਲ ਸਰਵਿਸਿਜ਼ ਕੰਸਲਟੈਂਟਸ ਇਹਨਾਂ ਨੇ ਆਪਾਂ ਨੂੰ ਦੱਸਿਆ ਹੈਗਾ ਵੀ ਜਿਹੜੇ ਆਉਣ ਵਾਲੇ ਸਮੇਂ ਦੇ ਵਿੱਚ ਆਪਾਂ ਟੈਕਸ ਫਾਈਲ ਕਰਨੇ ਆ ਉਹ ਬਿਜ਼ਨਸ ਜਿਹੜੀ ਟੈਕਸਸ ਹੈ ਉਹਨਾਂ ਦੇ ਵਿੱਚ ਕੀ ਬਦਲਾਅ ਆ ਰਹੇ ਨੇ ਔਰ ਆਪਾਂ ਨੂੰ ਕੀ ਸੋਚਣਾ ਚਾਹੀਦਾ ਜਦ ਆਪਾਂ ਟੈਕਸਸ ਬਿਜ਼ਨਸ ਵਾਸਤੇ ਫਾਈਲ ਕਰ ਰਹੇ ਹਾਂ ਇਜਾਜ਼ਤ ਦੇਵੋ ਮਿਲਦੇ ਹਾਂ ਅਗਲੀ ਵਾਰੀ ਮੈਂ ਇੰਦਰਜੀਤ ਕਾਲੀਰਾਏ ਤੁਸੀਂ ਦੇਖ ਰਹੇ ਹੋ ਸਾਂਝੀ ਸੋਚ ਟੀਵੀ ਤੇ ਅੱਜ ਕੱਲ ਅਮਰੀਕਾ ਥੈਂਕ ਯੂ ਜੀ